The information expressed in this video is my opinion and my opinion only. This information is for entertainment purposes only. Please do your own research. Hey everybody, Dave here, Hidden Fruit Investing, and welcome back to another video. In this video, I want to go over JEPI, because JEPI is quickly becoming my favorite ETF to invest in for income, for appreciation, and also for a little bit of downside protection in a different way. But in general, JEPI is quite different than new XYLD, XYLD, for example, Devo. We all pretty much know how those work. Well, not everybody, but you know, I trade options quite often, so I know how put options work. I know how call options work. So we know how those ETFs work in general. It's not very elusive. It's not very hard to understand what they're doing. So they make it pretty well known what they're doing by posting the call options or the put options. So in general, I'd say JEPI is an elusive ETF. We don't know exactly what they're doing, how they're doing it. We know some minor details of what they're doing and how they work, but we don't know the exact details. So that, in my opinion, makes it a little bit more riskier. And for some people, they're probably not going to invest in it at all, which, you know, that's their right to do whatever they want to do. It's their investment, it's their money. So, but anyways, I do think that JEPI is quickly becoming my favorite, if not my favorite, and so I think JEPI might be better than Nusia at this point, at least in my eyes. So it is a hot mess though, because we don't know exactly what they're doing, and let's go over a little bit more details in JEPI here. So okay, so this is JEPI right here. This is a Charles Schwab report card or fund report card or whatever you want to call it. So we do know that JEPI in general is a relatively new ETF. Okay, so it came out in what, May of 2020. So it's been out, you know, a little bit longer than a year now, and has a distribution yield of about 7.7, 7.5 or something like that. I think this is actually off a little bit if I'm not mistaken. So when it first came out, the distribution rate was kind of high. The monthly rate that came out was kind of high. And I think that they've kind of adjusted it down a little bit or whatever. I don't know why, but it just looks like maybe the trailing 12 months might be coming down the next, you know, several months. So we'll see. We'll keep an eye on it. So right now, this is a managed, not right now, this is a managed ETF. And it has a relatively low expense ratio at 0.35%. And it is also a fund from JP Morgan. So this fund is based off of the mutual fund. So the mutual fund version here came out in August of 2018. So we do have a little bit more information about what they're doing, although this requires a minimum of $1 million to invest in it. Has a higher expense ratio, and it's institutional customers only. So here is the actual Morningstar rating. So we got 4 stars. That's not bad. So let's look at a little more details of what JEPI is doing here. So here's a little bit more information about JEPI here. Their main objective is to provide income and have a little bit lower volatility than the S&P 500. In addition to having some upside as well. Doesn't that sound like the best of every world that we can get, right? We have upside, we have a little bit of downside protection in a way, and we also have a pretty good distribution yield, which comes out every single month. That is literally the best ETF, the thing that you could look for, if that's what you're looking for in ETF. Everybody is pretty much looking for those 3 things, right? Some way to not go down as much as the overall market, some way to keep up with the overall market, and also provide a distribution yield monthly that is relatively pretty high. Okay, now I guess I would say that anywhere about 6-7% is pretty darn high. So what they do here is they invest in mid-cap and large-cap S&P 500 stocks, you know, relatively trying to go investing in these stocks that are lower volatility than the overall S&P 500 stocks. So they're investing at least 80% of their assets into S&P 500 stocks, like I said, mid-cap, large-cap, but it doesn't have to be those. According to their documentation. In addition to that, they're not just looking for dividend paying stocks either. So that is kind of good. So it's right here. However, securities not selected based or anticipated dividend payment. So they don't strictly look at only S&P 500 stocks that pay dividends. So they're looking for low volatility stocks, which should provide less volatility to the fund. In addition, it also may provide a little bit of downside protection if the overall market goes down, 5%, and then S&P 500 it goes down 5% or something like that, then JEPI might only go down 4% or something like that. That's what they're hoping should happen anyway. So it's always hard to find beta numbers on ETFs. I don't know why, but it just is for some reason. So where do they get the income from? They get their income from these equity-linked notes here. So let's see here. They're investing about 15% into ELNs, which are equity-linked notes. An ELN is an equity-linked note, is an investment product that combines a fixed income investment with an additional potential return that are tied to the performance of equity. So what they're doing, and we don't know 100% what they're doing, but we do know that they're tying their ELNs to SPX, which is a cash, basically it's an S&P 500 index that is cash settled. We don't know if they're doing bond or something like that, but there is some sort of instrument that they're doing that should protect the principal at minimum. We also should be able to get some upside. In addition to that, we should also get some income from these LNs as well. There should be a little bit lower volatility. So the income that they get from these ELNs will also protect us from the downside as well, because the income, if we go down, X% or something like that, the income will offset the decline as well, in addition to paying out the monthly dividend. So it's not really a dividend, it's in a distribution. So ELNs, well, I looked more information up on ELNs, and it's not tied to an interest rate or something like that. It's mostly tied to the underlying index, right? So in this case here, it's SPX. So obviously they're doing calls written against the SPX, but we don't know 100% if they're doing at the money or, out of the money, or how far out of the money. We don't know any of the extent of the details at all of what they're doing. So that kind of makes it a little bit more elusive. Some could say it makes it a little riskier as well. I don't know. But I printed this out from today. Well, today's the 7th, but here is the 6th, so this is from Wednesday. And I tried to look up these security IDs and supplemental ID numbers, and you can't find them anywhere. I looked at Interactive Brokers. So I looked at Interactive Brokers structured products. I couldn't find these numbers anywhere, so we don't know, like I said, exactly what they're doing. But what's interesting here is it suggests with these negative deltas here, it almost suggests that those are puts, which is interesting because it doesn't say anywhere in their prospects or documentations that they do puts at all. It just says call options, written call options. That's all it says, which is interesting because I wouldn't expect a negative delta there. Basically from this, you really can't tell anything else at all. So let's go look at some other documents here real quick, and we can get a little bit more information at least about the ELNs. All right, so we do know that JEPI has invested in at least 80% of their capital into S&P 500 type stocks. We can see all those here. Now this is from June 30th because this is the latest one I could get. But you can see all the stocks that are invested in here. Let me scroll up all the way actually. And we can see it's 83% of the portfolio is in all these stocks right here. All right. Now we know there's a sector breakdown and all that stuff that shows you how the sectors are broke down, and a lot of it's in healthcare right now. And we scroll down right down here, so we see the equity linked notes. So here's equity linked notes right here, and these are the issuers right there. We know the expiry right there when they pretty much mature. We also know that they're tied to the S&P 500, which we already knew anyway from looking at the last document. And we also know the participation rate, which is this number right here, this percentage. Okay, so there's a percentage right there, there's a percentage right here, there's a percentage right here. Participation rate basically means that if the stock goes up, the index goes up, basically, let's say 5%, then basically this particular ELN should participate in 37% of that move, is how I understand it. So if we scroll down here, there's another one down here at the bottom. we can see that the total equity linked notes cost is $299 million is what it looks like. So, and then there's another one right there. It looks like they're spread out by about a week or so apart. So, and they're all some different issuers, which is good because it kind of, you don't want to be just stuck in one issuer, because who knows, there is a risk of one of those companies going default or something like that, or going under, and then you can be losing possible part of the value of that ELN. It goes through all the risks in the documents and all that stuff. And honestly, if you read those documents about the risks, it pretty much probably just turn you off from the ETF. But in general, I think every ETF has some sort of wording like that in it anyway. You know, the market risk, the credit risk, the swap risk, or whatever. So which is interesting. What else is interesting here is at the bottom here, we can see S&P 500 E-mini index, which is short. So it looks like they're running a hedge, which is kind of interesting. So pretty much, like I said, this ETF is a hot mess. They're doing a lot of different things here, and that could freak some people out. You know, in general, a hedge is not a bad thing. If they expect the market to go down, they're protecting their downside right there with the hedge. The ELNs in general also should provide income whether the market's going down or not. And in general, there's less volatility, provide less volatility as well. And in general, all the stocks that they have picked up, at least 80% of the portfolio, is lower volatility stocks in general as well. So in general, I'd say it's a pretty darn good ETF as far as protecting your capital. You know, you got to look at that fine print though. And like I said, every ETF probably has, you know, a lot of those risky things that they got to put in their documentation, you know, saying, hey, the credit risk is risky, or this, you know, every investment's risky. I mean, I always just say it, you know. So we do know that the distribution that we get from this monthly is from the call options that they write. And like I said, that negative delta kind of suggests that they had some puts, but it doesn't say anywhere in here that they invest or do puts at all, which is kind of interesting. So here's all the risks I was talking about earlier. Investment process. We got the equity market risk there. You got the general market risk, and then all that stuff. So, and then you got the strategic risk there. Let's see here. We got the equity linked note risk. So there's risk all around, right? ETF share trading risk, industry and sector focus risk. So there's just risks all which way around, including the freaking reach around. All right, call option risk there, large cap company risk, mid cap company risk. There's risks everywhere. So I bet you every ETF has something similar to that. Okay, tax information. So this is interesting. Everybody always asks about tax information with ETFs, and especially these income ETFs in general, right? A lot of them are return on capital, a lot are NII, and a lot are, let's see, ordinary income, capital gains, short-term, long-term, distribution. It could be a, you know, compass a qualified dividend as well. So how was JEPI tax? Well, what it says right here is those distributions will be taxed as ordinary income. So that could be maybe the ELNs are just interest income. And that's the reason why it's ordinary income, because, you know, interest income is counted as ordinary income. But it also just says that it's net income, investment income, which is ordinary income, same thing, or capital gains. So I think at least annually, at minimum, JEPI will do a capital gains distribution as well, according to their documentation anyway. So, and that will be, I would assume that would be short-term capital gains is my guess. But until I'm in this thing, I won't know, or until I guess April of next year, I won't know 100% how everything's taxed. So, but I'm just going by the documents right here. So looking here at FinViz, we can see JEPI's chart here over the last year. Doesn't look too bad, huh? S&P 500's been pretty much doing the same thing. Now, obviously, this is not going to, I think the S&P 500 is like up 17% or something like that year to date. We're up 8.39%, but we've also had a distribution yield of about 7.48%. So yeah, those together, and it's pretty much right in line with what the S&P 500's at, okay? But you also get paid out monthly, and that's, you know, the whole reason why people get into these income ETFs. Now, this is not the right move for everybody. If you have a long time to invest, maybe you should just stay in, you know, an S&P 500 index, something like VU or SPY or something like that, or something an equivalent from, you know, Fidelity or something like that as well. So this has actually performed pretty well, 8% up for the year. If you compare that against like XYLD or something like that, there's a big difference there. So let's look at XYLD real quick here. XYLD, and we can see XYLD here, 6.8% up and a 9%. So you actually put those together, and it's pretty similar to what JEPI has actually performed as well. But, you know, I mean, you have to compare these over a longer period of time and all that stuff because, you know, this is not an apples to apples comparison. XYLD has a, you know, way different strategy than JEPI. And I think JEPI will actually not go down as much as XYLD would. And I think XYLD, in addition to, you know, going down maybe more as well, I do think that the distribution yield that comes out, or distribution that comes out every single month, will vary more significantly than JEPI's will. Just looking here at Schwab, just to show basically the information here on the holdings. These are the top holdings right here. So we got Google in there, we got DTE, Intuit, Microsoft, we got ACN. A lot of these companies I don't even recognize because I don't really even look at a lot of these companies, S&P 500. But so there's a lot of good companies in there. This is basically the, you know, I got a, you know, I don't know how many are 93, I guess, the first ones here. Oh, nope, it's the top 30. So there's the top 30 when you have to go to the next line, or next line to see it. So we got fixed income. These are all the ELNs right there, and they show up as SPX in here. So like I said, they pretty much don't show much information about them. We do see that the maturity date right there. We also see the coupon, which is interesting. So I believe that's a participation rate, if I'm not mistaken. I could be wrong on that, but, and then we also have down here, they're invested in the money market fund as well, and we have the futures as well. And in the other fund, or the other document I looked at, it looked like they were short or hedged on the futures. I don't think that they're hedged right now. It does say short one, but I don't know what the actual one is short. If it says short there, most likely they're short something, which means they're hedged in some way on something. It could be the futures that they're actually hedged on. And the last thing we're going to go here is going to go through my portfolio and show you that I'm invested in JEPI, and I'm going to be investing more capital into JEPI as well. So let's go here to current portfolio and scroll down to the bottom right here. And I actually bought quite a bit of JEPI this week, and I'll continue to buy a lot more of JEPI because JEPI, I think the net asset value right now puts it right around 59.73, somewhere around that number. So it is trading at a premium right now, slightly, but I was able to pick quite a bit of JEPI up this week as well. And here's JEPI right here. So I have over 2,210 shares. Total value, $133,585 in JEPI, which generates over $9,284 in income at this time. And I do have plans to build JEPI up to $200,000, so I won't be investing my complete portfolio in JEPI. It'll be a mix between NUSI, JEPI, Devo, are going to be my main ETF. So that said, JEPI, like I said, it is a hot mess because there's a lot of stuff that's going on in the background, and we don't know 100% exactly the numbers or how that works because we don't know the numbers, right? We don't know the exact details. But in general, JEPI, if you want a fund that is not going to go down as much, possibly, that it should go down as much as some of the other income ETFs, it should be less volatile in the market, should provide stable monthly distributions as well, and also give you capital appreciation. I think JEPI is one of the best ones out there. Obviously, NUSI is a different strategy, so it's not going to be the same thing. QYLD, XYLD, for example, I guess this is really going to be compared to XYLD. You're really going to cap your upside, and I think the downside, you're not going to be protected at all. And in addition to that, I think the distributions on XYLD will vary substantially in a down market compared to JEPI. I think JEPI is going to be a little bit more stable on the distribution. So that's just my thoughts on it. So let me know if you have any comments, questions, or concerns about JEPI. Until next time, please go and like and subscribe. We'll see you next video. Thanks for watching.